Imagine waking up one morning and realizing Bitcoin and Ethereum just hit prices you thought were impossible. And it was not because of meme coins, not because of hype, but because quiet. Boring Wall Street money flipped the entire game while most retail investors were distracted. That shift is happening right now, and if you do not understand it, you will be the exit liquidity, not the beneficiary. Welcome to Generational Wealth, your pathway from knowledge to legacy. The brutal truth is this. In 2025, Bitcoin and Ethereum are not pumping because of crypto Twitter or retail FOMO anymore. They are pumping because your uncle's retirement account, massive pension funds, and the biggest asset managers on the planet are now buying crypto legally and at scale through crypto ETFs. And that changes everything for long-term price action. In this video, I am going to break down in plain English what a crypto ETF really is, how it works behind the scenes, and why it can push the price of Bitcoin and Ethereum higher, even when retail traders are scared or completely checked out of the market. If you are serious about building real generational wealth with crypto, tap that like button, subscribe, and let's get into it. So, what is a crypto ETF in simple terms? Think about a regular ETF first. If you have ever heard of an S&P 500 ETF like SPY, that is just a basket of stocks. Inside that basket, you have companies like Apple, Microsoft, Tesla, and so on, and you can buy that basket on a normal stock exchange in your regular brokerage account. A crypto ETF is the same idea, but instead of holding shares of Apple, it holds real Bitcoin or real Ethereum. That means people who have never touched an exchange, never set up a wallet, are terrified of seed phrases can now get exposure to crypto with a couple of clicks in the same account they use for their retirement. There are two main flavors of crypto ETFs out there. The first and most important are spot ETFs. These funds actually buy real Bitcoin or Ethereum and store it in cold storage offline. It's locked down like Fort Knox. We are talking about products from giants like BlackRock, Fidelity, and Grayscale. The second type is futures ETFs. Those funds do not own the coins directly. They own contracts that track the price. They were a big deal early on, but today, the overwhelming majority of serious money is flowing into spot ETFs, and that is where the real impact happens. Let's walk through exactly what happens behind the scenes when someone buys a Bitcoin spot ETF. Imagine your grandmother logs into her Fidelity account and decides she wants exposure to Bitcoin. But she does not want to deal with wallets, exchanges, or any of the tech. She simply clicks buy on a Bitcoin ETF like IBIT. Her money goes into the ETF. The fund manager then takes that cash and goes out to the open market to buy real Bitcoin, often through a custodian like Coinbase. That Bitcoin is then moved into super secure cold storage, and new ETF shares are created to match the amount of Bitcoin they now hold. Your grandmother walks away owning shares of the ETF, but behind those shares is real Bitcoin sitting in a vault. Now here's the crazy part. This is not happening with a few $1,000s here and there. We are talking about billions of dollars flowing into these products week after week. In the United States alone, Bitcoin ETFs pulled in tens of billions of dollars in 2024. And inflows in 2025 are on track to crush those numbers. So why does this make the price go up even when it feels like no one in crypto is buying? First, you have constant buy pressure with very little sell pressure. When an ETF buys Bitcoin for the fund, that Bitcoin is effectively taken off the open market and locked away. There is less available supply trading on exchanges. When supply shrinks and demand stays the same or increases, price naturally moves higher over time. Second, crypto ETFs unlock a completely new class of buyers. Think about retirement accounts, pension funds, sovereign wealth funds, insurance companies, family offices, and regular boomers who would never in their life download MetaMask or wire money to an offshore exchange. These people were never going to be direct crypto buyers, but they are perfectly comfortable buying a regulated ETF approved by their broker or advisor. That is potentially trillions of dollars in fresh capital that can now flow into Bitcoin, Ethereum, and eventually other altcoins. Third, ETFs create a legitimacy flywheel. Every time a major institution launches or buys a Bitcoin or Ethereum ETF, the headlines blast across mainstream media. The world's largest asset managers now hold Bitcoin. That media coverage attracts even more institutions and high net worth investors, which drives more inflows, pushes the price higher, generates more headlines, and keeps that cycle spinning. We watched this play out in 2024 when Bitcoin moved from around $40,000 to well over $100,000, largely on the back of ETF demand. And this is just the beginning. Looking at 2025 and 2026, regulators are opening the doors for even more products. We are seeing filings and approvals for Solana ETFs, potential XRP ETFs, basket ETFs that hold Bitcoin, Ethereum, Solana, and other majors all in one product, and even staking-focused ETFs that aim to provide yield on top of price appreciation. Each new ETF is like turning on another fire hose of institutional money pointed straight at crypto. Analysts from major banks and research firms have already thrown out targets of Bitcoin, reaching $200,000 to $300,000 by the end of 2026, just from ETF-driven demand combined with limited supply. No one can guarantee those numbers, but the math behind constrained supply and massive regulated inflows is very real. So should you care as a normal investor? Absolutely. When you understand ETFs, you understand the wave that is lifting the entire market. You can choose to ride that wave instead of fighting it. You now have the option, in many countries, to get crypto exposure through tax-advantaged accounts like retirement plans using ETFs. At the same time, this entire ETF movement proves something crucial. Crypto is not going away. It is being absorbed into the traditional financial system. But here is the key balance. ETFs are an amazing on-ramp and an incredible tool for some investors, but they do not replace self-custody if your goal is full control, censorship resistance, or using crypto the way it was originally designed. Think of ETFs as the bridge that brings the masses in, while direct ownership and cold storage remain the backbone for serious long-term holders. If this breakdown helped you see crypto ETFs more clearly, hit that like button, subscribe to Generational Wealth, and turn on all notifications because I drop beginner-friendly and strategy-focused crypto videos every single day. Drop a comment and tell me this. Are you planning to use crypto ETFs in your retirement or investment strategy? Or are you sticking strictly to holding your own coins? For trending topics and actionable crypto insights, visit our website at generationalwealth.biz. While you're on our site, visit the shop and grab a free copy of our Generational Wealth Crypto Blueprint and Beginner's Guide to Altcoins absolutely free. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.